The US dollar has reigned supreme as the world's reserve currency for decades. However, the winds of change are blowing. A growing number of nations are questioning the dollar's dominance, leading to a phenomenon known as de-dollarization. This trend involves countries reducing their reliance on the US dollar in international trade and finance. Instead, they are increasingly using alternative currencies or financial instruments. De-dollarization is driven by a confluence of factors. Some countries are seeking to reduce their vulnerability to US economic policies and sanctions. Others aim to promote their own currencies and financial systems. The rise of new economic powers such as China is also challenging the dollar's supremacy. As the global economy becomes increasingly multipolar, the financial system is likely to follow suit. Understanding the forces driving de-dollarization is crucial for navigating the evolving global economic landscape. The relationship between the United States and China is complex and multifaceted, particularly in the realm of finance. For decades, the two countries have been deeply intertwined, with China emerging as a major holder of US debt. This financial interdependence has been a defining feature of the global economy, but it has also been a source of tension. The US dollar's status as the world's reserve currency has allowed the United States to borrow at lower costs and finance its large current account deficit. China, with its massive export-oriented economy, has accumulated trillions of dollars in foreign exchange reserves, a significant portion of which is held in US Treasury securities. This arrangement has benefited both countries, with China finding a safe and liquid investment for its reserves, and the United States enjoying access to cheap financing. However, this financial interdependence has also created vulnerabilities and imbalances. The recent trend of de-dollarization adds another layer of complexity to this relationship. As China seeks to reduce its reliance on the US dollar, it is likely to further diversify its foreign exchange reserves and promote the use of its own currency, the yuan, in international transactions. In a move that sent shockwaves through the global financial system, China recently announced the sale of $23 billion worth of US Treasury bonds. This significant reduction in China's holdings of US debt is widely seen as a deliberate signal of its intent to reduce its reliance on the US dollar. The timing of this move, amidst escalating trade tensions and geopolitical rivalry between the two superpowers, has further fueled speculation about its motives and potential consequences. In recent years, China has gradually been diversifying its foreign exchange reserves, investing in other assets such as gold, commodities, and other currencies. However, the scale and timing of this latest move make it particularly noteworthy. It suggests that China is becoming more assertive in its efforts to challenge the US dollar's dominance and promote its own currency. The $23 billion sale is a relatively small percentage of China's total holdings of US debt, which still exceed $1 trillion. It is a clear indication that China is prepared to use its financial firepower to advance its strategic interests, even if it means incurring some economic costs. China's decision to reduce its holdings of US debt is a calculated move driven by a complex interplay of economic and geopolitical considerations. While the Chinese government has not explicitly stated its motives, several factors likely contributed to this decision. Understanding these factors is crucial for deciphering China's strategic playbook and anticipating its future actions. First and foremost, China is seeking to reduce its vulnerability to US economic policies and sanctions. By reducing its reliance on the US dollar, China aims to insulate itself from potential US pressure points. Second, China is eager to promote the internationalization of its own currency, the yuan. Reducing its holdings of US debt and encouraging the use of the yuan in international trade and finance are steps toward achieving this goal. Third, China may be expressing its displeasure with US policies, particularly on trade in Taiwan. The timing of the bond sale amidst escalating tensions between the two countries suggests that it could be a form of economic retaliation. China's move to reduce its holdings of US debt is already sending ripples through the global financial system. As the world's second-largest economy and a major player in global trade and finance, China's actions have significant implications for other countries and the stability of the international monetary system. One potential consequence is a rise in US interest rates. As China sells off its US Treasury bonds, it increases the supply of these bonds in the market, which could lead to lower prices and higher yields. Higher yields on US Treasury bonds could translate into higher borrowing costs for the US government, businesses, and consumers, potentially slowing down economic growth. Another potential impact is increased volatility in currency markets. As China reduces its holdings of US dollars, it will need to invest those funds elsewhere. This could lead to increased demand for other currencies, such as the euro, the yen, or the yuan, potentially causing their values to fluctuate. Increased currency volatility can disrupt international trade and investment, making it more difficult for businesses to plan and operate. Moreover, China's move could accelerate the trend of de-dollarization, with other countries following suit and reducing their reliance on the US dollar. While the immediate impact of China's move on the US economy is likely to be limited, the longer-term consequences could be more significant. The United States has long benefited from the dollar's status as the world's reserve currency, but this privileged position is not guaranteed. As China and other countries reduce their reliance on the US dollar, the US economy could face several challenges. One concern is that a decline in the dollar's status could lead to higher inflation. As the dollar weakens, imported goods become more expensive, potentially pushing up consumer prices. Additionally, if foreign investors become less willing to hold US dollar assets, it could lead to higher interest rates, making it more expensive for businesses and consumers to borrow money. Another concern is that a weaker dollar could make it more difficult for the United States to finance its large current account deficit. The United States has long relied on foreign capital to finance its trade deficit, but if foreign investors become less willing to hold US dollar assets, it could lead to a balance of payments crisis. Furthermore, a decline in the dollar's status could erode US geopolitical influence. The dollar's dominance has given the United States significant leverage in international affairs, but a weaker dollar could diminish this leverage. This could make it more difficult for the United States to achieve its foreign policy objectives. China's move to reduce its holdings of US debt is part of a broader trend of shifting global power dynamics. The post-World War II international order, with the United States at its helm, is being challenged by the rise of new powers, particularly China. This shift in the balance of power is having profound implications for the global economy and geopolitics. The US dollar's dominance has been a cornerstone of the post-war economic order, but this dominance is now being questioned. As China's economic and geopolitical clout grows, it is seeking to reshape the international system to better reflect its interests. This includes promoting the use of its own currency, the yuan, and reducing its reliance on the US dollar. The emergence of a multipolar world order is likely to lead to a more fragmented and complex international system. This could result in greater competition, but also greater instability. The recent moves by China and other countries to reduce their reliance on the US dollar raise questions about the future of money. Will the US dollar maintain its status as the world's reserve currency, or will we see a multipolar currency system? The answer is likely to be complex. The US dollar has several advantages, such as the depth and liquidity of US financial markets, the stability of the US political system, and the network effects of being the incumbent reserve currency. However, the dollar's dominance is not guaranteed. One factor is the relative decline of the US economy. While the United States remains the world's largest economy, its share of global GDP has been shrinking, while China's share has been growing rapidly. As China's economic might grows, so does its ability to challenge the dollar's dominance. Another factor is the rise of alternative reserve assets, such as cryptocurrencies and central bank digital currencies, or CBDCs. These new forms of money have the potential to disrupt the existing international monetary system and challenge the dominance of traditional reserve currencies. The future of money is likely to be characterized by greater diversity and competition. The US dollar may retain its status as the leading reserve currency, but it is likely to face increasing competition from other currencies, as well as from new forms of money. This could lead to a more fragmented and complex international monetary system. The trend of de-dollarization and the shifting global power dynamics may seem like abstract concepts, but they have real-world implications for people around the world. Here's why you should care. Economic impact. A weaker US dollar could lead to higher inflation, which would erode your purchasing power. It could also lead to higher interest rates, making it more expensive to borrow money for things like homes and cars. Geopolitical instability. The decline of US hegemony and the rise of a multipolar world could lead to greater geopolitical instability and conflict. This could have a direct impact on your safety and security, as well as on the global economy. Investment decisions. Understanding these trends is crucial for making informed investment decisions. As the global financial system evolves, it is important to diversify your investments and consider alternative assets that may benefit from these changes. By staying informed about these trends, you can better understand the forces shaping the world around you and make more informed decisions about your economic future.